Pretty wild day, as Ali was just mentioned there on Wall Street. Major indices climbing from the lows of the day, managing to post gains across the board. Nasdaq leading the way and bringing up the rest of the market along with it. Joining us now is B. Riley Wealth Chief Market Strategist Art Hogan. Art, always great to see you. So let's talk about this market. Art, this morning, get the CPI print. We did see, a slide there late morning, but then here comes Nvidia. Art surging 8%, leading us back. What do you make of today's trade?
Yeah, interesting day, right? So, the day is sort of like the week has been, right? So the first time that I can remember, we've seen an S&P 500 lose and gain 100 points in a single week, and that's very typical of September. I think the reaction to the CPI likely was an overreaction, and then we started getting comments from a multitude of conferences that are going on September's conference season. So it doesn't take much for Nvidia to get people excited about AI again, especially with the selling pressure that the group has seen over the course of the last 2 months. So a nice rebound there that took the rest of the technology group up with it, especially the AI adjacent names. But I think that when you take a step back and say, if our biggest concern is that today's modestly hotter core CPI number means the Fed's going to go 25 basis points versus 50. That was consensus coming into the day, right? So it just went from 70% to 85% consensus. So I think just a major overreaction in what has become an oversold September tape, and I think that the rally in the afternoon probably makes a whole lot more sense.
What about, I want to drill down on NVIDIA and the tech reaction a little bit, Art, and by the way, it's great to see you. So Jensen Huang, from what I read at the conference where he made comments today, he didn't say anything that crazy. He mostly reiterated that demand has been strong, and there really hasn't been anything to challenge that demand has been strong. Were people just looking for an excuse to get back in here on NVIDIA and some of the other big tech companies?
Yeah, so the semiconductors in general, down some 23% coming into the morning already, right? In the current sell-off in both, August and thus far in September. So you've got an oversold group. It doesn't take much of a push to get investors back in excited about a group that was trading significantly higher than this just 2 months ago. To the extent that his commentary was revelatory, it was much more about, hey, it's not just about data center. There are going to be other applications for artificial intelligence where you're looking at the tip of the iceberg. But to your point, what we already know is all the hyperscalers have reported and talked about their ongoing CapEx, where 80 to 90% of that's going to Nvidia. So clearly, oversold stock, oversold group. Calming commentary from the guy that runs the place, and it didn't take much to sort of start that fire.
Art, with the S&P 500 here at 55, 54, your year-end target, Art, is what?
5,700, and that's based on a assumption that we're going to see about $260 in earnings. Consensus is about 254 right now, and I think that with the beat ratio that we've seen for the first 2 quarters and the cadence of earnings for the second 2 quarters of this year, probably an attainable goal. Just put a trailing multiple on that, and you get to 5,700, or you could take a 12-month next 12-month multiple on that and get to the same place. But I think it's obviously it's been a bumpy road getting there, and clearly that looked a lot braver in January when that came out than it does today, because it's not significant upside. But I clearly think the path of least resistance for this market continues to be higher. If you look at earnings estimates for the next 2 quarters, they're low double digits, and we typically are conservative with those, so we'll likely do better than that. GDP's tracking at 2.5% according to the Atlanta Fed, and we had a 3% GDP growth rate in the last quarter. So while the economy's slowing a bit, we're still seeing an economy that's growing above trend and driving earnings growth. So that's kind of where we get to that year-end target and what the drivers are.
You mean you haven't changed the target 15 times since the start of the year, Art? No, I
just think that was way too brave at the beginning. I think people thought were looking at me like I had antlers or something. But
it's nice when it turns out. Although knock on wood, we still got a few months to go. But Art, do you think that to go back to technology, is that the best way to play it right now, or would you be looking to add elsewhere?
That's such a great question. When you look at the cadence of earnings going forward, the biggest part of that earnings growth is actually coming away from technology. So for the first time in this cycle, we're actually going to see the participation of the other 493 stocks in the S&P 500 actually grow their earnings at a faster pace than we've seen for the last year and a half. So I'm excited about technology and always will be. It's always going to be a core investment, but we'd also like to broaden that out as the market broadens out and look at some of the sectors that have underperformed, because I clearly think the earnings potential for the other the sectors other than tech and communication services is pretty exciting in the back half of this year and the first half of next.
How about small caps, Art? Do I want to own those?
You do. Interest rates are going down. The two things small caps need is an interest rate environment that's coming down. They're more dependent on interest rates as they're more dependent on debt. So as that comes down, that's a headwind that's turning into a tailwind right in front of us, and I think that continues well into next year. The other piece is you need sustained economic growth for the small caps, and clearly running at a north of mean 2.5% to 3% GDP growth rate this year is going to be another positive. The only reason they underperformed last year was clearly interest rates weren't coming down while we did have robust economic growth, but we're switching that around and we're going to turn two headwinds into tailwinds for the small caps, and this is the environment they tend to do well. The other piece of the puzzle, Josh, is that they clearly, the mean reversion they have is as wide as we've seen between small and large, going all the way back to 2000. So that tends to rectify itself, especially when you get a couple of catalysts like falling interest rates and steady economic growth.
And Art, finally, to close it out, I want to broaden it back out and go back to that 5,700, because a political question about that. Does 5,700 stand no matter who wins the presidential election?
Yeah, we love to talk about the presidential election and then try to make comparisons to what that might mean for markets. But at the end of the day, history will teach us that the best market we could have would be, agnostic of who's in the White House, a divided Congress, right? And that tends to be how markets do their best. If you go back, since 1950, it's always been, whether it's a Democrat or Republican in the White House, as long as they don't control Congress, markets tend to do great. And regardless of what polling you're looking at, it doesn't look like either side is going to run the table here.
All right, good to see you. Thanks a lot for joining us.
Thank you.